Hello and welcome to the Capital Stewards Podcast. I want to start out by shifting your mental framework for when to think about taxes. Tax time is now. That's right, in the fourth quarter of 2025, not in the first quarter of 2026. Once the year turns, there's only a few things that you can still do to impact your 2025 taxes. So now is the time to start thinking about strategies to manage your 2025 taxes. It's also the right time to find professional support to help you prepare your returns. After the calendar turns over into next year, CPAs book up and it becomes difficult, if not impossible, to find tax guidance until the end of April. So in this episode of the podcast, we're going to talk about year-end financial planning strategies and tips that you should consider. A lot of those are tax related, but I'll also cover some portfolio planning items as well towards the end. So let's dive into our episode for year-end planning tips in 2025. All right, so let's start with a public service announcement, or some would say one of Brian's soapbox issues. That issue is tax projections. Tax projections are so important. If you have significant assets or income that's more than $250,000 or $300,000 a year, even below that, it can be helpful, but certainly if you're a higher income earner, you need to have tax projections to help you understand what moves to make at year end. Here are a couple of examples of decisions that rely on understanding where your potential taxes sit before the end of the year. If you have employer stock options, the amount that you exercise this year is probably should be the amount that fills up the tax bracket that you're in, but doesn't create so much income that you move up into the next higher tax bracket. You won't know how much to exercise if you don't have a tax projection. Seniors, folks that are in their 60s, the expanded deduction that you receive starting this year that offsets some of that Social Security income, so the quote unquote tax-free Social Security from the One Big Beautiful Bill Act, that stuff phases out at $150,000 to $250,000 of income. So if you're doing a Roth conversion, you now need to consider the impact that increasing your income is going to have on your ability to qualify for that higher standard senior deduction. The amount that you convert might be reduced to keep your income below one of those thresholds. And you need to know all of that, of course, before you get to the end of the year, before you do those conversions. I'll also throw IRMA in the mix here. IRMAA. That's the rate that you pay for Medicare. As a lot of you know that are on Medicare, the higher your income, the higher rate that you pay for Medicare. You want to make sure that any tax planning move that you do takes into account those premium thresholds. When you want to stay just below them if possible, so that your Medicare insurance are as low as they can be, right? You need an income projection for that. So just a couple of examples that apply in some different scenarios, whether you're working still, an executive, or whether you're retired. All the planning tips that we're going to talk about are helpful on their own, but they're most powerful when you use them in concert with a tax projection. So, you need to know exactly how much income you're generating this year and then how that's going to impact your taxes, both short and long term. Without a tax projection, you're sort of flying blind, and that might lead to a suboptimal outcome. So, all right, I'll get off my soapbox now, but just as you think about this episode and some of these things, you may naturally say, well, should I do this? Or, how do I answer whether or not, this makes sense for me? Well, that answer generally starts with understanding how much income you're earning, what your tax projection looks like, and then going from there. So, all right, now that you've got your tax projection underway, let's move to my year-end kind of planning strategies that you can execute based on the results from that tax projection. We'll talk through these in a couple of buckets. The first bucket is items to think about that are related to retirement accounts. So we'll talk about that. Then we'll talk about healthcare and employee benefits, business income, and finally investment strategies as we come into year end. One of the most powerful tools for reducing taxable income is contributing to retirement accounts. Remember, retirement account contributions are generally tax deductible. For 2025, the employee contribution limits to 401k plans have gone up again. The limit for those under 50 is $23,500. And for those over 50, that extra catch-up contribution allows you an extra $7,500. So that brings the total up to $30,500. So remember, that's only your contribution. Your employer contributions can go beyond your employee contribution. So a total of $70,000 can be put into retirement accounts on your behalf. The most common form of additional contributions, obviously those employee matching funds, right, that you get. But if you have a side gig, if you own a business, if you have cash flowing real estate, you might be able to contribute to a retirement plan as an employer and as an employee. That potentially means that additional deductions for your business and your personal taxes. So don't forget to think about all of your income and make sure that you are potentially contributing as an employer as well as an employee. The total there, for per person across all of the different kinds of retirement plans is up to $70,000. So you can tax shelter a lot of money if you're being thoughtful about how to do that. If you're 73 or older, obviously you want to ensure that you take your required minimum distribution, those RMDs from retirement accounts before the end of the year. Again, planning for those ahead of time can help you manage the tax impact of those distributions by spreading them out over time. So RMDs, make sure you take them before the end of the year. And if you do some planning ahead of time, hopefully, it won't be too big of a hit on your taxes. If you have an inherited IRA, make sure you take a look at the distribution rules with your tax planning professionals. We've changed some of those the last few years. They were constant between last year and this year, but I think a lot of folks are still figuring those things out. So generally speaking, you've got to distribute all of the assets in an inherited IRA. So that's an IRA maybe that you got from your, could be from your spouse. And in those cases, there are some different rules. But if you got it from, say, your parents or from your grandparents, something like that, another family member, generally you got to take that money out over 10 years, regardless of your age, unless you meet certain exception kind of qualifications. So careful planning is required there. Those rules have been in flux. So if you've got an inherited IRA, make sure you're talking to folks about doing that so that you take those distributions appropriately. Consider Roth conversions. This is the next category. And notice conversions is not singular, it's plural. Remember that Roth conversions generally work best over multiple years to spread out their tax impact. So think about Roth conversions as a series of conversions, not as a one-time event. A Roth conversion involves, for those of you that haven't heard of these before, it involves moving funds from a traditional IRA or a 401k to a Roth IRA. You pay taxes on the converted amount, and then you enjoy tax-free growth and withdrawals later on. This can be particularly advantageous if you expect to be in a higher tax bracket in the future. Even if your overall tax rates remain low under the Trump administration, your income may go up and increase your tax bracket. But as you age, that's a normal thing that happens. So you don't have to believe that tax rates are going to go to the moon for conversions to make sense. When you get into retirement, you're going to have those required minimum distributions that we were just talking about. In your 80s and 90s, you're talking about taking more than 10% out of your retirement accounts, out of those 401ks and out of those IRAs to meet that required minimum distribution threshold. So that all of that unnecessary taxable income, a lot of times that's the rationale for converting funds to a Roth prior to retirement or at the very beginning of retirement. So it's really important though with Roth conversions to do long-term planning and income forecasting with your financial planner, with your tax professional to get that right. Remember my soapbox from earlier in the episode. So think about Roth conversions as we go into year end. Second bucket of things I want to talk about is related to healthcare accounts. So a lot of times this is tied to the health insurance and the benefits that you get from your employer. First topic here is flex spending accounts. So if you're getting a flex spending account or an FSA through your employer, it's great things to have. They allow you to set aside pre-tax dollars, kind of like an IRA, for medical and dependent care expenses throughout the year. So sometimes you can use those for child care. You can use them for elder care, parent care thrown in there sometimes. You can use those FSA dollars for lots of different kinds of things. You don't have to pay taxes on that money as income. So that's a good thing. There are contribution limits, $3,300 for 2025, but still worthwhile tax savings for most folks there. The most important thing, though, as we get to the end of the year with FSAs, different than a health savings account, your flex spending account, it might be a use it or lose it kind of setup. So some FSAs, you put money in at the beginning of the year or throughout the year, and then you have to use it all before the end of the year. Other employers will allow you to roll over some amounts, but not all of the money that's in there. So you want to look at your FSA account, see how much money is in there. If you got a few $1,000 sitting in there, make sure you're using it throughout the year so that you don't lose it before next year. If you have flex spending account money and you don't have a lot of medical bills coming up, like I said, make sure you use the money before the end of the year. Let's talk about health savings accounts. So flex spending account, different thing. This is part of your health insurance benefits. Health savings accounts, separate from your actual health insurance, is a kind of account that you can open when you have a qualifying health insurance plan. And they are the only triple tax advantage account that exists. So they're not only a way to save for medical expenses, but they're also a really good strategic tool for tax savings. Contributions to HSAs are tax deductible. The money grows tax-free. And then when you use it for qualified medical expenses, withdrawals are also tax-free. So it's triple tax advantage. Money never gets taxed. So as long as you're using it for healthcare expenses. For 2025, the contribution limit to HSAs is $4,300 for individuals and $8,550 for families. And then there's an additional $1,000 catch up if you're over 55. So that's a lot of tax deferral power, especially for families that have healthcare expenses. So don't miss out on health savings accounts. If you have one in a health savings account, unlike an FSA, you can invest that money, roll it over year. So even if you don't have a lot of healthcare expenses now, if you're building a family or younger, you might have, certainly will have some healthcare expenses down the road. And if you've got a little nest egg built up there to take care of those things, then you have a really good way to do that. So don't sleep on health savings accounts if you don't already have one of those. Let's talk about investing in taxable accounts for those of you that have assets outside of the traditional retirement account world. One of the most common December headaches is those mutual fund capital gains distributions, especially in years when the market's been up. And so this year would apply to that. So if you're investing through mutual funds, you might get those what we call phantom year-end capital gains distributions. Those distributions occur when the mutual funds sell stocks for a profit or a gain. The capital gains taxes on those investments have to be paid by taxable investors that are in the fund, which would be you if you're a person. And typically what the funds do is they distribute those gains to investors in December, which might increase the total amount of gains that you take for the year unexpectedly. So if you're receiving capital gains regularly from a fund, it might be worth thinking about using ETFs instead of mutual funds, especially if the mutual fund's not performing particularly well. In that case, you're paying the taxes and you're not getting the results. But in an ETF, you only pay capital gains taxes on your actual realized gains in the fund, not the underlying fund trading. So it's one of the main reasons why ETFs are more tax efficient than mutual funds. And the proliferation of ETFs means that you can probably come close to replicating your existing mutual fund strategy, actively managed or passively managed, with a better tax outcome and perhaps at a lower cost by using an ETF instead. A lot of the mutual fund providers now have ETF listings for everything that they have a mutual fund for. So consider flipping over to that ETF instead of the mutual fund strategy if you're getting a lot of capital gains distributions from funds. And converting over to the ETF doesn't create a big tax event in and of itself. Next thing to think about for taxable investors is tax loss harvesting. Tax loss harvesting involves selling investments that are down throughout the year and realizing those losses so you can use those to offset gains that you take at other points in the year to reduce your overall capital gains tax liability. And then you can use a little bit of that to offset your ordinary income. You should be proactively harvesting losses from your portfolio as you go throughout the year. Even though the stock market has been up this year, certainly not everything in your portfolio has been up all year long. So for example, in April, we had a big downshift in the market right after all the tariff announcements. And so that would have been a great time to harvest some losses, reinvest, and then have those gains to help offset other gains in your portfolio, or have those losses to be able to offset other gains in your portfolio as we get later in the year. So if you haven't been doing it as we're going through the year, then make sure you're actively looking at taking potential losses to offset gains as we get to the end of the year here. The next bucket of items is on controlling your income. This really applies to folks that either are business owners or have an outside business or a side gig or something like that. So, and I think this is something that a lot of people sort of forget to think about as a tax strategy, but it's sort of like the basic thing, right? Everybody focuses on retirement account deductions, maybe some healthcare insurance things, HSAs, et cetera. But but they forget that you can just control your income perhaps, and that might help you manage your taxes. So you want to look at your projected taxable income for 2025 and 2026 if you own a business or if you manage a partnership or something like that. And if your income is really high in some years and low in others, that could mean you're paying more tax than you have to. So you might be better off sort of smoothing out your tax rate over time and maybe taking more income from your business in some of those lower years and then reducing the amount of income that you take from your business in some of those better performing years. So this is also a strategy that's really important if you pay alternative minimum taxes or if you might be in a bucket where you're exposed to the alternative minimum tax regime. Controlling your business income can be a way to avoid the AMT tax. So again, if you're self-employed or you own a business, just think about controlling your income, your deductible expenses, all those other kinds of things before you get to the end of the year. And then the last category of tax things I want to talk about before we move on into investing is charitable deductions and my general thesis around contributing to charities. So first, I always encourage you to be generous. Be generous to your church, to your family, to the community. But I suggest that you define what your giving goals are before you start planning for taxes. Your philanthropic goals should be the main driver of what you're giving away, not your taxes. But once you figure out where you want to give and how much you want to give and the ways you want to be generous, then when we start thinking about how we want to execute those gifts before we just go write checks, that's when tax planning comes in. You think about the most tax efficient way to do your year-end gifting. So one just kind of general thesis here is that charitable gifts are slightly less beneficial from a tax perspective starting next year, so starting in 2026 because of some of the changes in the One Big Beautiful Bill Act than they are this year. So you might, if you're thinking about bunching charitable gifts or, should I wait till next year to give something or give it this year, you might give those gifts in 2025 instead of waiting until 2026, or perhaps give money, right at the end of the year instead of waiting until January to do that. Going forward, starting next year, gifts have to exceed half of a percentage point of your adjusted gross income to be deductible. And then if you're a high income taxpayer, you can only receive that deduction at the 35% level, not at the 37% the top tax bracket rate. So just a little bit less generous of a tax code for people that want to be generous going forward next year. So think about maybe moving some of those gifts into 2025. When we think about what we're going to give, markets are up again significantly this year. So think about donating appreciated assets like stocks or mutual funds. That not only provides the deduction based on the fair market value of asset, but it also avoids you having to pay capital gains taxes on the appreciation. The organization can sell it. Most organizations know how to facilitate these transactions. So you just want to reach out to the gifts coordinator or financial manager, or talk to your financial planner or your advisor. They can help you coordinate those gifts and do direct asset transfers so that you don't have to pay capital gains taxes on your gifts. Really, really great way to do gifting as we get into the end of the year. If you're 70 and a half, if you're in your 70s and you have to take those required minimum distributions, qualified charitable distributions from your IRA can be a great tool that allows you to donate around $100,000 directly to charity, which counts towards your required minimum distribution. But because it's a charitable donation, it's not included in your taxable income. It goes directly from the IRA to the charity, not to your bank account, then to the charity, right? So how you do that again is important, but you can meet your RMD requirement and help out a good cause at the same time. So again, like I said before, don't let the tax strategy drive how you're being generous. But when you get ready to think about what the best way to make those gifts are, think about giving other assets besides cash. Think about using your IRA. Think about bunching those donations into the tax year that's going to give you the best sort of bang for your buck from a tax perspective. Lastly, let's talk about investment portfolio strategy for a minute. So I already talked a little bit about tax loss harvesting. That alone might create some natural rebalancing that happens in your portfolio throughout the year. But if you have not been actively rebalancing throughout the year, now is an ideal time to do that. Returns have been really strong this year in the stock market and in gold really recently, right? Nothing goes up forever, right? We've seen that over the last couple of weeks in the gold market. And nobody, not even the sharpest investment minds in the world that are powered by AI, can predict when the market's going to sort of turn around and go the other way. So in the Outlook episode for this quarter, I made the case that I don't yet view this as a stock market bubble, but I do think prices are inflated after a year of really strong returns. And what's the goal of investing? It's to sell when the price is high. So now is an excellent time to take some of those gains off the table and rebalance your portfolio. That doesn't mean sell everything you own in the stock market, but let's take some of those excess gains, right, if we're overweight in our stock portfolio, and add to some things that haven't grown quite as much. That's also the best way to prevent a disaster. If we do get into a market bubble and a subsequent downturn, the best way to prevent a really bad outcome there, it's not to be able to predict the downturn. Nobody can do that successfully, or very few people can do that successfully. But it's the best way to prevent something really bad from happening there is to stay diversified on the way up, so that your portfolio is somewhat insulated when the inevitable stock market drawdown does happen. So use year-end as a reason to rebalance, kind of reset for what will hopefully be another strong year of gains in 2026. So, all right, anytime we go deep on tax situations, I'd like to remind all of you that taxes are very personal. They're very different from situation to situation. So in this episode, it's kind of meant to be a starting point to spur a deeper conversation between you and your advisors. You want to talk to your CPA, your financial planner, and other professionals out there that you work with before you start making any decisions that have a direct impact on your taxes. So if you don't know who to talk with, you can reach out to me directly. I'd be happy to help you get moving in the right direction on any of these topics. But don't just take the stuff that we talked about in this episode and apply it. Make sure you're talking to your professionals, getting projections, all those kinds of things, so that you make a really smart, really wise year-end planning decisions. So, and that is a wrap for this episode of the Capital Stewards Podcast. We will see you next